If you've been involved in the stock market at all these past 12 to 18 months, then I'm sure you've noticed the market doing just one thing: go up. That being said, however, bullish strategies have not been the only kind of strategy that has actually worked in this runaway market. In fact, directionally neutral strategies like short strangles, iron condors, straddles, etc., those can actually work very well in any kind of market: bull markets, bear markets, cyclical markets, etc. And based on my own experience trading through this market, I definitely know that to be true because the majority of the trades that I make are actually directionally neutral. Specifically, I sell short strangles most of the time, which is basically selling an out-of-the-money call option and an out-of-the-money put option at the same time. And in case you want to take a deep dive into that particular strategy and understand how it works, I do have a separate video on that topic, and I'll post a card above linking to it. But having said all that, I still do understand people's hesitations around using directionally neutral strategies in a runaway bull market that we've been seeing for the past 18 months. So that's why in this video, I'm going to show you a directionally neutral strategy that still has zero risk to the upside. So specifically, you're going to learn about the Jade Lizard strategy. This was developed by Liz and Jenny over at Tasty Trade. If you don't know who they are or what Tasty Trade is, I recommend you check them out. They're a great content producer around options trading. But the Jade Lizard is very much like an iron condor, so it is directionally neutral. Ideally, the stock you are trading it on, you want that stock just to move sideways. But if the stock does just explode, which has been very typical in this market, you can still walk away with a very small profit. Now, as always, before we dive in here and I show you how the strategy works, in case this is the first video of mine you come across, my name is Scott Reese, and welcome to my channel, where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And if you want to see more options trading and investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. And so with that being said, let's jump on over to my computer now and we'll get things started. Okay, so the stock I'm going to use here to demonstrate how the Jade Lizard strategy works is going to be Alibaba, or BABA. The reason being is the implied volatility for the stock is still very, very high. And anytime you are selling options, basically taking in a credit initially, you always want to use these strategies on stocks with high implied volatility like this. And that's because high IV means high option prices, which translates to you collecting a larger credit when you sell those options. So now let's come over to the trade tab here and take a look at the option chain on Alibaba, and we'll go into the October expiration cycle. All these options here expire in 48 days. Typically, when I look to sell options, I want to be within 30 to 60 days out from expiration. So 48 is basically right in the middle. And so, as I said earlier, the Jade Lizard strategy is very similar to the iron condor, where the iron condor is just the combination of selling an out-of-the-money call credit spread and also selling an out-of-the-money put credit spread. And that structure is what makes the iron condor directionally neutral. Ideally, we want the stock, in this case Alibaba, to just bounce around in a range and move sideways. And that's still the ideal scenario for the Jade Lizard strategy as well. But the main difference is the Jade Lizard has no risk to the upside, whereas the iron condor certainly does. So what we're going to do here, the first step to putting on a Jade Lizard is we're going to sell an out-of-the-money call credit spread. So for example, I'm going to sell the 175 strike call and then buy the 180 strike call. So let's go ahead and set that up. Right click and go to sell and vertical. And by default, it brings the order up down here. Sell one contract, 175 strike call, buy one contract, 180 strike call. And then also I'm going to change this order type to first trigger sequential, and I'll explain that in a second. Now take note of the credit we're going to receive for selling this call credit spread. It's going to be $122. Now the second and final step of putting on the Jade Lizard is instead of selling a put credit spread like an iron condor, in this case we're just going to sell a naked put. But the key thing here is we can't just sell any one of these out-of-the-money put options. We have to sell a put for enough in credit to cover the max loss scenario on this call credit spread. So in particular, let's bring up the calculator real quick to make this easy. And I'll move this over here. Now I am going to assume here you have some very basic knowledge on the call credit spread or just credit spreads in general. If not, don't worry. I have a separate video that takes a deep dive into the call credit spread. I'll post a card above linking to it so you can watch it. But the first thing we have to do here is figure out how much money we will lose in the worst case scenario for this call credit spread. If Alibaba, for example, were to just explode in price over the course of this expiration cycle and blow through our call strikes, how much money can we lose on this credit spread? Well, it's very simple to figure that out. We first take the width of the spread, which in this case is $5 wide, and then we subtract from that the credit we receive for selling this credit spread. So up here we take 5 minus 1.22, and that gives you 3.78. And then finally, we just multiply this by 100 for the 100 shares all these contracts are tied to. And there we go. The most amount of money we can lose on this call credit spread is $378. And again, if you don't fully understand why that is or how that works, definitely watch my other video taking a deep dive on the call credit spread. It will explain in detail how this fully works. But if this is the maximum amount of money we can lose on this call credit spread, that means we have to sell a put option for at least this amount in credit in order for this Jade Lizard to have no risk to the upside. So perhaps then I want to sell this 140 strike put option because I could sell this one for around $450 in credit. So let's go ahead and click on the bid price here. And then as you can see, it went ahead and added that put option to my full order down here. So the full credit I'm going to collect for putting on this position, let's bring back the calculator real quick. We're simply going to add together these two credits. So 122 plus 445 equals $567 in credit. So now let's say over the course of this expiration cycle, we are totally wrong on this position. Alibaba just explodes in price. And come October 15th, the price of this stock is well above both of our call strikes. So that means we have a max loss situation on our hands for the call credit spread. And as you saw earlier, in this case, we're going to lose $378 on this call credit spread. So I'll make this a negative number, but also don't forget in this scenario, if Alibaba does just skyrocket, that means this naked put option is going to expire worthless. So you will keep the full $445 you sold the put for, which means we can add to this $445, and that leaves you with a positive $67 profit. And that's what makes the Jade Lizard here have no upside risk. Obviously, as you can see here, your profits will be much smaller if you are directionally incorrect on this position, but you're still actually able to make a profit. There are no losses to the upside. And then of course, in the ideal scenario, if Alibaba just kind of bounces around within this price range, basically above 140 and below 175, right? These are the short option strikes. Then if by the expiration date, let's say Alibaba ends up at $155 per share, right in between, then all these options are just going to expire worthless. And in that case, you'll get to keep the full amount of credit, the full $567. So that's what makes the Jade Lizard strategy still a directionally neutral strategy. And just to give you a visual sense of where these strikes are, let's zoom in a bit here on the charts. 140 is all the way down here, just barely shown on my chart. And then 175 is up here, right at the peak or the high of this short-term rally. So that's a pretty nice wide range for this stock to just bounce around in. And again, the stock can end up anywhere within that range by the expiration date, and you'll make a very, very nice profit. Now, of course, the main caveat with this strategy, there's always a give and take with this kind of thing. You can't have no upside risk and not give anything up in exchange for that. So in this case, the caveat is you do have theoretically undefined risk to the downside, right? Because this is a naked put option, not a put credit spread. So that's why you will still need to have very solid mechanics in managing this position if Alibaba just totally plummets. You can potentially roll this put out in time to the next expiration cycle, or you could short some shares of stock to slow down the bleeding if it really starts to plummet. Or what I would recommend is simply to close out of this whole position at a certain stop loss point. But don't forget that you do also have a lot of credit here that you can use to offset any losses. Specifically referring to losses if the stock does actually plummet, because in this case with this strategy, that is the only way you can lose money. So if you're collecting $567 in credit for this Jade Lizard strategy, that means your break-even point on the downside is a full $5.67 below your put strike. So real quick, bring back the calculator. 140 minus 5.67 is 134.33. If the stock falls down to this price by the expiration date, you will still at least break even. The only way you can actually lose money on this position is if by the expiration date the stock is below this price. And just to give you an idea of the chance or the likelihood of that happening, let's focus on the 135 strike put option as a close proxy or a close estimate to this break-even price right here. So specifically take note of this percentage, this 24.38% on this 135 strike put option. This is the chance or the probability of Alibaba falling below this price by the expiration date. And as you can see, there's only a 24.38% chance of that happening. And ultimately, that means if we take the inverse of this probability, that means there's about a 75% chance of that not happening. A 75% chance of Alibaba staying above 135 by the expiration date. So this Jade Lizard down here has a very, very high chance of turning a profit. Because again, if the stock ends up anywhere above 135, or specifically above 134.33, anywhere above this price, you will walk away with some money, period. You'll walk away with the most money if the stock stays in between your short strikes of 175 and 140, but still anywhere above this price, you'll make a profit. And then lastly, I do want to mention what this first trigger sequential actually means, or what this order type actually means. It simply structures this full order such that it's first going to try and get this credit spread filled. And then once that is done, once you do get filled on this credit spread, at that point, it will then try to get filled on this naked put. So basically, it's going to sequentially walk down all these orders here. There's only 2 in this case, but it's going to basically execute these orders sequentially. First the credit spread, then the naked put. You don't have to do it this way. This is simply the way I would do it. You can also do just a blast all order. And so in that case, it's just going to send both of these orders out at the same time. So you might get filled first on your credit spread, or you might get filled on your naked put first. So you can definitely do it this way as well. It's totally up to you. So hopefully this explanation here made sense. And now you have another very great and different strategy that you can use in this crazy bullish market without having to fear losing money if the market does just keep charging higher. So with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.